Welcome to the Deep Dives. Today we're really digging into a piece of legislation causing quite a stir. It's the Stablecoin Genius Act, just passed in the Senate.
That's right.
And you've given us this critical article why passing the Stablecoin Genius Act might not be so smart, plus the full text of the act itself.
Right. Mm-hmm.
So our mission is to unpack this. What is this bill? Why are some people calling it like history in the making?
Yeah.
And importantly, why are others warning, hang on, this might not be so smart, maybe even risky for the financial system?
Exactly. And just to set the stage quickly, stablecoins, well, there's these digital assets, right?
Yeah.
Designed to hold a steady value, usually pegged to something like the U.S. dollar.
Right, the dollar mostly.
Yeah, mostly. And they've been in this kind of regulatory gray zone. Some regulators see them as securities. This act, it wants to change that fundamentally. Pull them into the mainstream financial system, treat them as ways to pay, not as investments. That reclassification is huge.
Okay, so let's get into the specifics. The full name is, well, it's a bit of a mouthful, the Guiding and Establishing National Innovation for U.S. Stablecoins of 2025.
Or just the Genius Act, thankfully.
Right, the Genius Act of 2025, introduced back on February 4th, 2025 in the Senate. And it had bipartisan sponsors, Haggerty, Scott, Gillibrand, Loomis. So it looks collaborative on the surface.
Yeah, it does. And its main job, its core purpose, is to set up rules for what they call payment stablecoins.
Payment stablecoins, okay.
And a really key shift, it's right there in Section 14 of the Act, and the article highlights this too. It explicitly says these payment stablecoins are not securities.
Not security.
And not commodities either. That's a massive distinction. It carves out this whole separate regulatory lane for them, different from Bitcoin or other crypto assets.
So separating them from the pack.
Exactly. Potentially making it easier for them to be used in, everyday finance. The idea really is to make them seem as solid as the dollar they're pegged to, backed almost like gold used to be in a sense. That's the push for legitimacy.
Okay, so that explains maybe why the supporters are so, well, enthusiastic. You've got Jeremy Allaire. He's the CEO of Circle, a big stablecoin company.
USDC.
Right. He said the Senate vote was, history is being made.
Yeah.
He thinks it'll drive U.S. competitiveness for decades.
Big claims.
Yeah, and Senator Haggerty, one of the sponsors, said similar things, positioning it as vital for the U.S. to lead in digital finance. Sounds transformative, doesn't it?
From their view, absolutely. And they'd point to the protections baked into the act for people holding these stablecoins.
Okay, like what kind of protections?
Well, Section 4A1 is key. It says issuers have to hold reserves backing the stablecoins, at least 1-to-1.
1-to-1 backing. What counts as reserves, though? Can it be anything?
No, it's pretty specific. U.S. coins and currency, deposits in insured banks, short-term treasury bills like 93 days or less maturity, certain repurchase agreements, money market funds, maybe even deposits at the central bank. Basically, safe, liquid stuff.
Okay, that does sound quite restricted, quite safe on paper. But, are there loopholes? Could 1-to-1 not always mean perfectly safe in reality?
Well, the intent is definitely robust. And it's not just the reserves themselves. There's transparency required, too. Section 4AD says issuers have to publish their redemption policy clearly.
Right.
And they have to post the makeup of their reserves online every month. How many stablecoins are out there, what assets are backing them up, broken down.
So anyone can check.
Supposedly. And then Section 4A3 adds another layer. Monthly checks on these reports by a registered accounting firm.
Ah, an audit.
Yeah, and the CEO and CFO have to personally certify these reports each month. If they lie, criminal penalties.
Wow, okay. That's a serious deterrent. But I wonder, for the average person, does knowing a CFO might go to jail really help if the stablecoin itself loses value? Or is it more about the assets?
That's a fair question.
And what if the issuer just goes bankrupt? What happens to my money then?
That's a huge concern, and the Act tries to tackle it head-on in Section 9. It gives stablecoin holders priority if the issuer goes under, like first in line ahead of basically all other creditors.
Really? First priority?
Yeah. They actually amended the U.S. Bankruptcy Code, Section 507 of Title 11, specifically to give these claims first priority. That's a very strong protection, trying to make people feel safe, like their money is protected similar to a bank deposit.
Okay.
Oh, and also Section 4A5 makes these issuers financial institutions under the Bank Secrecy Act. So anti-money laundering rules apply.
Right, bringing them into the existing AML framework.
Exactly. The takeaway from supporters is holder protection is paramount.
Okay, so beyond the rules and safety nets, there's this idea about making payments better. Christian Catalini at MIT, he suggests this could mean faster, lower cost global payments. How would that actually work? Like if I'm buying something on Etsy or sending money overseas?
Well, his argument is it could shake things up quite a bit. Think about how payments work now. You've got Visa, MasterCard,
Yeah, the big networks.
or even PayPal, Klarna, services like that. They often don't play well together, right? They limit interoperability because, well, it protects their business model. You can't easily zip money from PayPal to Cash App directly.
True. Annoying sometimes.
Exactly. But Catalini says with stablecoins on a blockchain, the different wallets, the fintech apps, the services, they would be interoperable by default.
Ah, so they could talk to each other easily.
That's the idea, potentially cutting out middlemen, fees, delays, especially for international payments. A much smoother, potentially cheaper global system.
Okay, that's a compelling vision.
Yeah.
Faster, cheaper, more connected. But there's always a but, isn't there?
Almost always with big changes like this.
While that sounds great, a lot of public interest groups opposing Democrats, they see this whole thing differently.
Very differently.
They point to the crypto lobby. Well, there's like $265 million spent in 2024 trying to influence elections and policy.
Yeah, huge numbers. For these critics, this isn't just about technology, it's about political influence.
And that leads to some sharp criticisms. Mark Hayes from Americans for Financial Reform, he didn't pull any punches.
No, he didn't.
Called the act a collection of half measures. Said it gives stablecoins a stamp of approval without actually fixing the dangers. He called it an uncontrolled experiment.
Uncontrolled experiment. That phrase really sticks out.
It does. What does he mean by that specifically? What dangers haven't been removed in his view? Are they thinking of past financial crises?
Precisely. Hayes makes a direct comparison to the Commodity Futures Modernization Act of 2000.
Ah, the CFMA. That didn't end well.
Not entirely, no. Many argue it weakened the oversight of derivatives significantly, and that played a role in the 2007-09 financial meltdown.
Right.
So Hayes is saying, we've seen this movie before. The fear is that by creating this new framework, maybe without enough regulation, the Genius Act could accidentally set the stage for future instability. New products getting ahead of the rules again.
So systemic risk worries, even with the rules we just talked about. And what about the stability of the stablecoins themselves? We've seen them wobble before, right?
Absolutely. Despite the reserve rules, critics point to past depegging events. Tether fell below $1, down to 95 cents back in May 2022.
I remember that.
And Circle's own USDC, supposedly super safe, dropped under 87 cents during the Silicon Valley Bank crisis in March 2023.
So even with reserves, things can go wrong. Do critics think this act prevents that?
They argue it doesn't go far enough, or worse, it might introduce new risks. Corey Freyer at the Consumer Federation of America paints a pretty concerning picture.
Okay, what's his take?
He worries that if stablecoins get really big and they hold lots of cash in regular banks, or if banks themselves issue lots of stablecoins, a run on the stablecoins could actually cause a run on the banks holding the reserves.
Wow, domino effect.
Yeah, he calls it a transmission channel, connecting the, super volatile crypto world directly to traditional banking. And he says that's incredibly dangerous. The fear is that crypto's problems could spill over and infect the whole system.
That is. Yeah, that's a scary thought. And Freire also mentioned this idea of lots of different private digital currencies popping up.
Right.
Like Bezos bucks or Zuckerberg bucks. What would that even look like for us day to day?
He thinks it would be incredibly confusing. He said, people will be using Bezos bucks, Zuckerberg bucks, Trump bucks for payments. And there will be no guarantee that these new forms of dollars will always be worth $1.
So you wouldn't know if your digital dollar is the dollar, or which one shops accept, or if its value might dip slightly.
Exactly. It's the opposite of the simple, trusted, single national currency we have now. Could erode trust, create hassle.
Okay, that brings us to maybe the most controversial part. The ethics, the potential conflicts of interest.
This one has generated a lot of heat.
The Act does have a conflict of interest rule in Section 4A7. It says members of Congress, senior executive branch officials, they can't issue stablecoins while they're in office.
Seems sensible.
But legal experts are saying there's a gap. It apparently wouldn't apply to the president or the vice president.
And that's not just a theoretical loophole. It's become very relevant very quickly.
How so?
There's a crypto startup, World Liberty Financial, majority owned by the Trump family. They announced back in March they're issuing a stablecoin called USD1.
Trump's family has a stablecoin, USD1.
Yeah, and reportedly it already has a market cap around $2.2 billion. So, Mark Hayes, the critic we mentioned,
Yeah.
he stated it pretty plainly. If this bill passes the full Congress, it is certainly possible that Trump's stablecoin could become one of the dominant parts of the crypto ecosystem, which would be extremely rewarding to him. So, the concern is direct financial benefit tied to policy.
Wow. Okay. That's quite a connection. And there's more to this USD1 story, isn't there? Something
Yeah.
about finance.
Yes, another layer. USD1 was reportedly part of a $2 billion investment involving an entity linked to the UAE government, an investment in Binance.
Binance, the huge crypto exchange whose founder just got sentenced for money laundering.
The very same. And that founder is apparently seeking a presidential pardon. This whole transaction involving USD1, the UAE entity, and Binance prompted Senators Merkley and Warren, both opponents of the Genius Act, to call for an investigation.
An investigation into what?
Potential violations of federal bribery laws. Serious stuff. Senator Merkley said the bill basically stamps a congressional seal of approval on President Trump selling access to the government for personal profit.
Okay, those are incredibly strong accusations. We're moving way beyond just technical financial regulation here.
We really are. And, stepping back, these worries about private money, about different entities issuing currency, it's not actually new. There's a historical echo here that critics like Freyer and the economic historian Barry Eichengreen point to.
Oh, what's the history lesson?
It goes back to the time before the U.S. Civil War, the wildcat banking era.
Wildcat banking. Sounds chaotic.
It was. Back then, lots of private banks issued their own paper money, their own banknotes.
So literally printing their own dollars. How did that even work?
Well, supposedly, each bank's notes were backed by gold or silver reserves. But the value wasn't stable at all. A note from one bank might be worth less than a note from another, depending on the bank's reputation, how far away it was.
So you travel a bit and your money is worth less.
Exactly. It led to constant confusion, bank runs, failures, just financial chaos. People didn't trust the money.
How do they fix it?
Eventually, Lincoln's government stepped in, partly to fund the war effort. They passed the National Banking Acts in 1863 and 1864. These laws set strict rules, created national standards, and really helped establish the single reliable national currency we know today.
Bringing order out of chaos.
Right, and that's why Freyer finds it so ironic. He said it's an ironic situation that we should be on the verge of returning to a system of private monies after everything we have learned. It's a warning. Maybe we shouldn't forget why we moved away from that system in the first place.
Okay, so wrapping this up.
Yeah.
What does this all mean for you listening to this? It feels like a real fork in the road.
It does seem that way.
On one side, you have the promise of the Genius Act, fostering innovation, making global payments faster and cheaper, maybe boosting U.S. competitiveness,
Oh.
real potential benefit.
Interoperability, efficiency.
But on the other side, you have these serious warnings. Are we rushing into an unstable system like the wildcat banks? Are we creating new ways for crises to spread? And layered on top, these really pointed ethical concerns about conflicts of interest right at the top.
It really forces a fundamental question on us, doesn't it? As digital money becomes more part of our lives, how do we strike that balance?
Balance between...
Between, the excitement of new technology, speed, innovation, and the absolute need for financial stability, for protecting consumers, and for basic integrity in the system. Can we get the benefits without taking on massive, unacceptable risks?
It makes you wonder, will this Genius Act actually be remembered as genius, as ushering in a new era of better finance? Or will future generations look back and see it as one of those uncontrolled experiments that went wrong, a lesson we maybe should have learned from history? Definitely something to think about as this digital money landscape keeps changing.